There we are. All right. Good evening. My name's Steve Hodgdon from Modern Asset Management, and this is January 26, 2022. And I'm grateful that we have a small group of folks to talk about real estate this evening. And so let me just run through our little opening PowerPoint that I made to set the tone for what we're trying to do today. This is pointed toward those of us that are small investors, which I think is all of us that have, most of us are not accredited, and it's how do we get along in this world, since all the really big juicy good deals go to the people that have already gotten all the big juicy good deals. So I'm going to talk about a couple of notes. That's a spot where people start a lot. JV partnerships. I'm in partnership with two people that are on the call this evening. LaDacia in Alexandria, Louisiana, and Sunrise Acquisition Services in Pensacola. Mostly this is about small dollar real estate. I live in California and I'm not playing $1 million fixers. Might talk on options a little bit, but there's a 1,000 ways to try to do something in real estate. And so first thing I'm going to do is, those of us that have spent time in seminars or go on calls like this with other folks, it's always a pitch, right? And so I try not to make a pitch. I try to give some balance. And so I just bought a little land contract note in Texas a few months ago. It fit all of the things that make me think that I'm doing the right thing. So it was a land contract in Texas. It's easy to repossess in Texas. It's $500 a month. That interests me because that's a payment worth taking. It only had 5% interest, which I typically am charging 8 3/4, 10% on seller carry paper. The note was originated by a real estate agent, and it had a $17,000 balance at sale. Payments had been made. The balance was down to $13,800. So 7 payments were made, and then 4 payments have been made since the purchase. There were good credit borrowers. These were people that were buying, people in Florida that were buying some land in Texas with a target of being, it was like 10 acres. It was going to be their retirement heaven. I paid $11,400 to buy a note that had a balance of nearly $14,000. So I look at my investment to value. The original sale was $21,000 with a $4,000 down payment. And so I paid $11,000 against an asset that was sold for $21,000. So I feel like I'm pretty good at around a 50-60% loan to value. But the $510 payments at 5% interest, when you run that in the calculator, you come back to a gross yield of 22%, which is a yeehaw home run, right? And but there's costs. There's taking the payment, paying the bank fees, notices, all that kind of stuff. If you placed it with a servicer, FCI would charge you $15 a month to take this. If you put it with another company, it may be 30 plus. But we're self-servicing because we run our own lending business. So we're used to taking payments. But so that was a note that went great. But sometimes a little note can have a big problem. This is a low value house that
I'm coming.
It's a low value house that we purchased in Pensacola, and we sold it to a tradesman for $25,000. I put $1,000 down, and I put them again on what I like $500 payments. So I put them on a short term. I think it was like an 8-year note when you did the math. Principal, interest, taxes, and insurance for $500 a month. I think there's $360 that goes to principal and interest at a 10% interest rate. So he did great. He did great. But then health issues come up. He's got no work. He said he's a tradesman. He doesn't have health insurance or any kind of network underneath him. So his payments start to get spotty. Then he gets COVID and hasn't been able to make a payment now for several months. But he's paid $13,000 to date. And this is an example of why maybe you don't self-service, right? If this note was sitting with FCI or Madison or Allied or one of the licensed servicers, he'd already have, excuse me, a notice of default, and a foreclosure proceeding would be starting. And I talked to this borrower in text messaging. So just because that's going on, he's going to get another month or so of runway to try to fix this. He is communicating. He's telling me he's trying to get some sort of takeout loan. But the question is, if you're starting to buy lower end notes, the borrower always looks like the property. If it's the house is in rough shape, the borrower is going to be in rough shape, and things are going to happen. And certainly this national flu, this national pandemic, international pandemic, has put a lot of people in trouble. I've got another renter in Florida who has just been stellar, and the wheels have come off. Completely, the wheels have come off. And I had 6 years in 2 houses with her, and now it's just unraveling, and she can't seem to get a grip. So, and this was the slide on that. So that's the quick and dirty of, you can buy a good little note, and it can be a great little note. I've had many of those. You can buy a note that you think is going to be good, that has some story to it, and it's going to behave like the story. If people had trouble before, they're going to have trouble again. So we come to Zoom calls like this, we go to seminars, we read, we study, we experiment and try, and we're all, every pitch I see says better than market returns, or 8% guaranteed plus. And I see people buying. What prompted me to take this on today was I see people buying turnkey properties and getting themselves, thinking they're chasing a small dollar deal, thinking they're going to get a 20% return. And then you get things like the house I just showed you. It does great for a while, and then it just unravels.
Yep. Should we be seeing a slide?
Yeah, you should be seeing a slide that says, you should be seeing a slide that says, can you make a deal better?
All we see is you.
All you see is me. Well, that's fantastic. That's great.
You do look really good.
I look good today. I've moved. So did you see any of the slides I put up?
Negative.
Oh, that's hysterical. All right. Let's try this share screen button. Quick, let's share screen and get caught up.
There it is.
Okay, slide 1. See, I hunted for this picture.
Hilarious.
That's why I don't get paid. I made this pretty one where it shows, all my little things that happen. Look, 22%. That's fantastic. This poor, mournful little house down here, right? Oh, I can't go back. So note holder, what did I want to tell you? I wanted to tell you the tenant or the note holder always looks like the property. And the inside, so and also if you're buying non-performing paper, the inside of the house always looks like the payment history. If they were terrible on the payment history, they didn't care about the house, and it's destroyed inside. Right? So my note that went great is mixed up, and so here, this is where we were. Can we make a deal better? And we come here looking to do this passive income magic thing that I have kind of figured out, but not really. So we should be able to find places to make 7% safely. That's just the margin in today's interest rate world. Bank interest rates go to 5%, then our yields will go to 9%. There's always some spread in there, but there's inherent risk. We're playing with stuff that the big banks won't buy. You can get 10% return if you spend a little time working at things. That's been my experience. Anything over 15%, I'm falling out of passive and into at least some level of active, underwriting deals, deciding where I'm going to put money, talking with folks along the way, giving suggestions or being a sounding board for questions from folks on the ground. I try to, this part of my work, I'm trying to do at my desk with nothing but my phone and no staff. We've got a little team that runs our traditional lending portfolio. And so what do we need? We need to get really lucky. We need to get lucky and pick good partners and stay with them. We have to pick good REITs. Anybody that bought a self-storage REIT 2 years ago is really happy because they're worth double what they were. Anybody who bought a shopping mall REIT isn't so happy right now because Sears closed, right? And the other way to make more money is to take the partner out and manage projects yourself. Be the other side. Use somebody else's money to get to goal for everybody. We've all ridden the inflation trend in real estate. Real estate people will call this appreciation. Those of you who have seen me before know that I had at one time I had a $5 million strip mall in Denver, Colorado. That turned out to be worth 2.5. Oh, John's here too. Everybody poked me and said that they couldn't see the slides. That I rode all the way down to being worth half of what I paid for it, and then rode it all the way back up to come out of it okay. I was not so smart in 2006 when I thought I was a genius. By 2008, I had learned that I knew nothing, and have spent the last decade plus trying to come back to not being quite so stupid. My flaws are, there's always a better idea. There's always something else. I get emotionally attached to partners and projects. I get all in, I double down, I do whatever I can. Like I said, I showed you this mortgage that should already be, have a notice of default and be on its way to formal foreclosure. And, I can't put this guy out in the curb. I may have to. I can't get it into my head that boring is better. And I have to fix some of that. I have to be happy with 10, 12% steady returns, no noise, just easy. But I like to play in this space too much. The things that I'm working toward is everything has to be repeatable, scalable, ethical, and beneficial for all, including the partner and the end user. I haven't taken any investor money in a long time. That's going to change. And I have always made sure that my investment partner, whoever put the money in, is they always get paid before I get paid. And if you keep that in mind, if you start to do that, then people will continue to come back to you. And so Sunrise Acquisition Services and I are looking at this. I bought this in a tax deed, and it's not quite the rectangle here. We can see Joaquin Road. It's a little more square. It's a little bigger. But this was a development. This is Lillian Highway. This is part of Pensacola. This is water down at the very top.
Perdido Bay.
Perdido Bay. Thank you, Eric. And you can see there's a lot of trees. So you've got some big acre lots here. We've got an acre lot here. Going below this picture, it's trees, 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 trees for a while. But somebody came along about 20 years ago and built this lovely row of nice homes. And so here we are at the end of the block. And we're hoping, we know for sure that we can put 5 units here on this. We can split this lot.
16 as of yesterday with Lee.
Okay, 16 yesterday with Lee. Okay, nobody knows who Lee is. Lee's an engineer. And so functionally, we can put 16 units here. Is that right?
Yes, sir.
Okay.
Yes, sir.
So here we are. Let's talk about this. Why would this be a good deal? What's it going to take to put 16? You know, it's always put you on the spot a little bit, Eric. What's it going to take to do that?
The engineering looks like it's going to cost about 20 grand. On the south part of the lot, which is the bottom of the page, there's actually a drainage ditch that may make it less expensive that the county put in years ago. So our retention pond, which is required when you do more than 4 units in this area, will probably be on that side of the lot. So we've got kind of a thumbprint of what we think we can do based on a 2-story townhome setup that Lee's got on file. So it's going to take about $20,000 to $25,000 with an engineer, and anywhere between 2 weeks and 3 months time for that to get put together. Before we do that, we'll do the mini DRC with the county and get the initial approval. It's zoned for it, so the approval is not really going to be an issue. They just have to like the infrastructure that we're willing to put down.
Okay. And there's city services in the road there. And this road continues south, and the road was put in to allow for plan for development where all those trees are. Does that fit the neighborhood? Does this fit with what's going on here? 16.
This neighborhood clearly doesn't have a bunch of townhomes, but within a quarter of a mile, there's a couple of areas that do. The demand for rentals here is more than off the chart. It'll fill up as soon as we put a sign up. I mean, immediately. The rent for what we're planning on at this point will be somewhere between $1,600 and $2,000 a month for a brand new small 3-bedroom, 2-bath townhome. Without a garage, it'll have just either a carport. That just kind of depends on the final, or open parking in front of the units.
Mm-hmm. Okay. Take a year to get done?
We could be building in probably about 5 months. Not like California, where it takes a year to get a permit.
Or
The mini DRC takes a couple weeks. Then we'll have to go to a board to be fully approved, even though it is zoned for it. That usually takes less than a month. We could be building pretty quickly. The engineering is going to take longer than it will with the county.
Okay. All right. So if you were gonna pit, if we were gonna here we're gonna sideways pitch this, right? So if you were looking for investors, you'd want to say, this is 6 months to get to construction, another 6 months to get to finish and tenancy, or a little longer.
There's 6 and 6, and what was the thing you said after that, Steve?
Yeah, so is 6 to get ready and 6 to build about right, or do you need a longer run?
I'd say 6 to get ready. I think we could do it a little less, and let's say 10 to build, just because we won't be building all of them at the exact same time. We'll probably start with the first 2 buildings.
Mhm.
Part of the final thing we get the engineers is Lee says we can get 16 in there, and Lee's actually the architect, kind of the planner. He's got an engineer that's standing by. So there's absolutely no doubt we can do 12, but he's pretty sure we could get to 16. So we're based our numbers on 12 initially. If we can get to the 16, that would be super. It's not wide enough to go down both sides like we'd initially thought about, unless the units are just too short. So we're going to focus on one side. We got 284 feet to use. Part of that depends on what the county will allow us as far as adjusting the setbacks slightly.
Right. Okay.
So yes, to get back to your question, 6 months to get ready, and then 10 months to build them out.
Okay. So add in having to build up some reserves, all this stuff, you can be safe to say 2 years you'll have cash flow coming. And that scares off most folks, right? It's like, well, I want some retirement money now. There's a lot of risk in time, and we've been we're 6 months in. I was 6 months into a fight to get clear title on this property, so I'm not backing down now. But for me, this goes to the boring thing. I put some money away. We let it sit there. We tag some preferred return to either be paid as we go along. Some interest can be paid during the period. So say you needed let's say $500,000 from investors, and for starting construction, and you held back $50,000 to make interest payments for the first year. 40,000 or whatever. You could do that and then pair that with a building loan. So what would we do? We'd put in 100,000. We'd add investors in equal share at that point. We'd tenant and then get a takeout loan in the middle of after like 6 months of seasoning and making sure that the property's stable, and pay the investors back their 500,000, and then they still maintain ownership and regular share of monthly rents. Right? So I said that way too fast. So if you needed to raise, what are you going to build? So I say we built 10 at $150,000 each.
It's killing me.
Right? Does that sound right? Right. And so
That sounds right.
Yeah. So you need $1.5 million. You can borrow maybe the whole $1.5 million from Builder Finance or Lima One. But if you wanted to bring in partners, the partner would have to be like me, be able to park money and wait for 2 years for flow to come. The two REITs that I've done like this, those were rehabs, but they were 3-year projects, both returned 40% in the 3 years. And so I want to open up the floor. So I wanted to put it out there as, here's an example of how you can be how you can be a small investor in something that's a little bigger. And then it's what to do, right? You know, why am I always chasing new projects? It's fun. You know, this is what I do. I'd rather do this than go to casinos and vacations and whatnot. I love that it's a team sport. I really enjoy not being the smartest guy in partnerships. It's, you know, if I'm the smartest guy, we're in trouble. I've really enjoyed in the past year financing newer investors in JV deals, watching people flourish and grow into their chosen path has just been marvelous to be part of. Why do I keep coming back to Pensacola? This is going to be I think this is project number 10. And they all haven't been perfect, but they've all gotten to the finish line. They've all turned into what they were supposed to. I'm fascinated with lots of mobile homes in Alexandria, Louisiana, with LaDacia, who's on this call. The idea of providing affordable housing in a part of the world where people really need it feels like a chance to do pretty well and do some good at the same time. I completely have no focus. At my age, I should only be focused on cash flow, and yet I'm chasing quick exits all the time. I run a trade desk these days. I've got 2 properties in closing right now. I've got 3 new in acquisitions, and I'm sending wire. If I don't send a wire every week, and this is not my job. If I'm not sending a wire, receiving a wire every week, I'm not doing something right. And the big focus I have to make is I have to get everything I do pointed at capital gains, not ordinary income. You know, those are my things. I need less partners, people that I can count on, and a combination of building some long-term cash flow and letting me play my little game. So we'll come out of that. Yeah, that was the end of my slideshow. We'll come out of that and look for feedback, questions, stories about what's gone right and wrong with you. Let's have a chat for a little group. For us, there's 15 of us here. Oh, LaDacia, you sent me an email today. What happened with if there are any of you that have watched us on YouTube before, there's a property called Daspit. LaDacia owns Daspit. So what happened in Daspit today?
We finally received the certificate of occupancy. Finally, after 3 months, 4 months, I think, since October 15th, we got clearance and I can rent it out.
Okay. All right. And that's
All inspections passed.
okay. And you think your rent number is still going to be around 900?
Definitely.
Okay.
Yes. I've already spoken with Housing Authority, Alexandria Housing Authority for Section 8. Already put it on their list. We're gonna get 900 and 650 deposit. I kind of helped with that.
Yeah. So that's when you said it was going to be a low deposit. I figured that's this idea of meeting people where they are. I see people out here in California looking for 2 and 3 months deposit, right? And that's not going to work in your town. People aren't sitting around with $4 grand in their pocket ready to give it to you.
Right.
So do you have a gut feel about how much this extra time costs? Do you have an idea how far over budget you wound up?
It really wasn't that bad, honestly. I think I went over, I would say about $4,300. We started at 30,000, and a few things came up with the AC and electrical, but it's about 4,300. It wasn't that bad.
Okay. So this was a house that I took back in a foreclosure action that had turned into a squatter house and really had been, it was an okay house. It's in a good little neighborhood, and it was an okay house, and it just got beat to death. Bringing it back took Ladesha a lot of work, but the financial end result of that is all in for about 65,000 with $900 a month coming back in rent. So that's 990, that's
108, 10 8.
10.8 against an investment of 65,000 and
Mm.
like 6 months of your life, so, and that's the part that we don't put a number to, right? But that's okay. You put that in your calculator, that's a good return. And
Oh.
1,700 cash on cash.
right.
I mean,
So,
17%.
yeah, 17% cash on cash, and that's pretty good. And we did some creative financing stuff to make that happen too. So she didn't come. Her cash on cash is going to be better until we have an exit for her to buy me out. And so, but we've talked about Daspit a lot, and to see it finally done is, it's,
And it's
Right.
beautiful.
yeah. Oh, yeah. The before and after pictures of this place are, it's like, oh, it's an entirely different home.
Thank you.
So, yeah. So congrats. Anybody have a topic? Have something we wanna air out a little bit?
Mm.
So I don't know folks well enough to. Oh, well, let me go back to Sunrise. A question, and something else that's in the works right now is another little house called Lincoln. Eric, are we still thinking that pouring money into it is the answer?
I think that one is going to go back to a rental.
Okay.
There's a central system is being added on Monday, and did a little bit of a minor cleanup there, but there are some renters that popped up that should work out beautifully, and the rent can be pretty nice.
Okay.
The rent market here has just gone through the roof. So we were going to rent it, and then we were going to sell it, and now we're back to renting it.
Right. And who's going to own it? I own it right now.
The paperwork will be sent to you shortly, sir.
The patient investor, well, kind of patient. We bought this house 5 years ago, put it together, have had it sold on seller finance, and have had 2 tenants in it over this 5-year period. Every time we had a turnover, we had to write a check that was nearly equal to the rents recovered for the rents collected for the year. So if we had a tenant in for a year, we had $10,000 in rent, we had $6,000 in repairs. It was just one of those kind of things. Older home, needed stuff. Well, we've done all the stuff, right? So, so Sunrise, who's been patching it together every year when we turn over a tenant, they're going to buy it. And the return back to us is good enough, right? It's good enough. And it gets, what it does is it gets a little rental, a little rental out of my world. I bought it, I paid to repair it, we've tenanted it. I've done everything I can do to make it better from California. And at this point, it needs the hand-holding of somebody local. So I can put it with a property manager. I've been a property manager. No disrespect to property managers. I've been a property manager. The job's impossible. It just is, for every reason. But it's better to have it as a starter house in Sunrise's inventory than just this thing on the side of my balance sheet that I can't make it any better than it already is. You know, we've experienced a significant rise in property values, right? And I get to take those chips off the table and go put it into a new project to start. You know, so I can take, you know, 50,000 in cash or 70,000 in cash. I think it's going to be from Sunrise for the Lincoln House, and now I can go find someplace better to put that. So, all right. I don't have I've changed offices. I don't have a clock on the wall. I don't know what time is it. Doesn't matter.
Let's see if I can fix it.
What do we have from our guests that we want to talk about? This is open season. Let's tell a horror story. Brag about something that worked really well.
Hey, Steve, I got a question.
Yeah.
I want to ask you, are you buying the notes in your IRA?
So I have notes in a health savings account. I have
Okay.
notes in a Roth. I've got notes in our C Corp, and I've got a couple little quick turn notes that I'm actually holding personally.
Okay, got it.
So the notes in the HSA are with Quest Trust Company.
Okay,
And the 401k stuff is an LLC under the company 401k plan. Right. So we set up a qualified retirement plan, and my partner and I each put in the maximum amount of money, and then that we fund in an LLC, and we write checks and receive income in that LLC.
okay, got it.
And Schwab was really easy to do that with.
Okay,
So if there's one of my many failings is keeping track of that stuff, because it's paperwork, man, and I don't want to do paperwork. You know,
okay, got it.
The short-term stuff I've been funding are rural land flippers, and wholesalers. There's a wholesaler out in Riverside that I've put some money into a couple of things. He's really creative. He's borrowing my money to put options on properties that he's then selling. So he's given a owner $20,000 cash for a 90-day right to sell their house, and then he's selling that contract to an end buyer.
Okay.
So he's
Yeah, that's pretty amazing.
Yeah, so he's making a spread of like $50,000 in these deals. And so, you know, to give me, you know, to use my 20 to get 50, I mean, he's so smart. He's just so
Yeah.
smart.
Yeah, that's amazing.
Yeah, but it's a full-time business for him. It's him and a partner, and they mail good. I have no idea how many offers they make. Anything that goes to probate or list pendants in Southern California, I think he's going to get a letter from him.
Okay, got it.
Yeah. So, you know, so that's what I'm looking for, is looking for folks that can, you know, that have got a machine, know how to do the work, and just need some funding to get to the next level. So, and then again, having some in and out quick stuff feeds my attention deficit disorder thing. But it's not boring, and boring is like this target I have to get in my head. Yeah.
Steve, you mentioned you're in California. Where are you?
I'm in Novato, Marin County right now.
Oh, okay. I'm in Santa Rosa.
Oh, funny. Okay. Hi.
Close by. Hi. So this is my first time here. I'm actually a newly licensed mortgage broker, but I've dabbled in, tax lien certificates. I've built a spec home, built my own house, just a little of this and a little of that. I almost bought a rental property in Oklahoma City, and it was all of nature, Mother Nature told me not to do it, including sheltering in the basement of the hotel during a tornado with the wedding party. That's a story for another day. But anyway, I've always loved investing and just looking how to get involved in it, whether it's from a mortgage standpoint or from an investor standpoint.
Yeah. And so if you had to choose between playing with paper or with lumber, which was better for you?
I'm playing with paper now because I don't have the assets to do much more, but I actually love the concept of flipping homes and having rental properties.
Yeah.
So and I also sold real estate at the height of the market, and I currently have both my real estate and my mortgage broker's license.
So I was selling real estate at the bottom of the market in 2009, 10, and 11, and that's again, like I said, another story. I've got 5 acres under contract, gone into escrow near a reservation in outside of Oklahoma City.
Oh,
Yeah.
okay.
And that was a deal with a land flipper that they were all in for it's 2.5 acres, all in for $11,000. And we're supposed to close. I'm not bragging. Supposed to close for $35,000.
Wow.
Right?
Yeah. Yeah.
Right?
No, I mean, I literally flew out to Oklahoma City. I was supposed to buy a new construction home for $150,000. And it was supposed to be in the black from day one. But this was before I got my mortgage license. And I was employed at the local healthcare system. And I told them I wanted to buy it with funds from my self-directed 401k. And they said, oh, sure, no problem. They gave me a pre-approval letter. And then I booked my flight and said, hey, I'm going shopping. And they said, well, you have money somewhere else. And I'm like, no, it's in my self-directed 401k, like I told you. And you have to put twice as much down and have much better reserves and purchase the home in the name of the 401k. And yeah, it was fascinating. It just totally blew up on me, which this was 6 months before COVID and before they eliminated my position at the hospital. So it all worked out that it didn't work out.
Mhm.
But interesting anyway.
Yeah. Well, and we know what banks will lend. We know what government supported banks will lend to, and what criteria you certainly know now.
Oh yeah.
Yeah. And so to go back to risk and touch a little on risk profile. People were buying houses that shouldn't have been buying houses back in that crash. People are buying houses with 3.5% down now that I don't think makes sense. That shopping center that I sold a building, I sold a commercial building in Novato and thought I was going to be a big time guy. I put 25% down on the shopping center. I put $1 million in change plus 800,000 in repair money. I put nearly $2 million up, and it wasn't enough.
Wow.
Right? So it wasn't enough.
Yeah.
Cyclically, that $5 million asset is now worth $7 million.
Right.
But I was trading out of a 5 cap in Novato into a 10 cap in Denver, and I thought that was genius. Right? I had no idea what the risk was. I mean,
retail is so challenging right now.
Yeah.
I mean, I'm from Denver and I know what happened to the retail market there. There are some ghost towns of shopping malls there now that were fantastic when I was a kid.
Yeah. And it's just, so it's, so that chased me back to single family, which is where I had been before. But I didn't want to be a landlord. So I bought 33 notes in 12 states. And that wasn't smart because I had to learn the rules in 12 states. Right?
Wow.
And I had to learn, I had to learn that, you know, I owned collection agencies for 20 years. So I'm a really good, nasty, bad guy. Right. You know, I'm good at pushing the lawyer and doing all that stuff. And so that's what's saved me. But I don't know a thing about fixing real estate. I can't roof. I can't shingle. I can't do any of that stuff. So it's, you know, what can I do? So I thought I would just play with paper. And what came out of that was I need to be in a few neighborhoods. Right? I need to be in a few neighborhoods. And I decided that I liked tertiary markets, you know, the secondary, tertiary markets so that chases me out of California. Right. You know, so although I know lots of people in California that are really happy, they never sold anything they bought. Yeah.
Well, I think the only reason to buy in California is because you want to live in California. You know, because the reality of it is rents are just going to continually go up. But as far as ROI with the rental property, you'll be much better off somewhere else.
Well, but the function is, again, if I had held on to things, I've got
Oh yeah, that's true.
Yeah,
for sure.
I've got one rental in Roanoke Park.
Okay.
The basis is 350,000 and the house rents for 3,500 a month.
Oh yeah, I mean, if you definitely don't want to get rid of anything.
Yeah.
But if you're buying investment properties, I think there are places with a better ROI, which is why I was looking in Oklahoma City. I mean, you can buy a house for 150,000 there, and it pencils out right away.
Yeah. Well, Ladesha's house, 65,000 in, 900 a month out.
And is that in Oklahoma City, Oklahoma?
Nope, that's in Louisiana. It's in central
Louisiana. Yeah.
You know, so you have to get to linear markets if you're looking for cash flow. But the big house buyers, the Blackstones of the world, they're buying everything they can at retail.
Right.
So because they're banking on the federal government continuing to keep the money flow going, and I'm banking on the federal government to keep a Section 8 program going. I want to rent Section 8. I want to rent through Ladesha to the federal government.
I'm with you. I really would like to be able to figure out how to help with our housing issues at the same time. I mean, the homeless issues out here have gotten ridiculous, and it would be really nice to, you know, as a single mom, figuring out how to make housing more affordable for the average person would be wonderful.
Yeah. So maybe we can do some of both of those things, right?
That would be awesome.
Hey, Kathleen, what part of Oklahoma are you investing in?
Well, no, I'm in California. I'm in Santa Rosa, but I looked in Oklahoma City. I can't remember what they called the area. It was right outside of Oklahoma City. It was new construction. But again, if I had done that, 6 months later, they eliminated my job, and 8 months later, COVID happened. So I could have been in a world of hurt if that had gone through.
Yeah, okay. Because I know Oklahoma is a great market for creative financing.
Oh, okay.
Find you some properties down there. Oklahoma City, Okmulgee, Muskogee, maybe Norman. I used to go to school down there, so
yeah. My parents lived out there for a while.
Oh, okay.
And my extended family is from Kansas, so I'm somewhat familiar. But
I'm from Kansas too.
Oh, really?
Yes,
Nice.
I am.
Nice. Yeah, my parents are from the Wichita area, but yeah, I was going traditional route. I was looking though to use money in a self-directed 401k as the down payment on my house. And the lender just didn't tell me until I was actually headed there to buy it that if you're buying out of a 401k, you have to put twice as much down, and you'd have to have a cash slush fund
Oh,
you
wow.
know, and it's a lot different when you're buying out of your 401k than if you're buying out of cash that you have outside of a retirement account.
Okay, wow.
So,
But now I'm a mortgage broker, so I'm supposed to know that stuff now.
so Kenny, what do you think of Oklahoma as an investment spot?
Well, I was actually I had a relative. He was in I think Muskogee. So I was gonna look at some try to do some creative financing down there, but I don't know if I'm gonna do it now because he's moved back to Kansas City, but because I don't have no boots on the ground down there, so I don't know if I'm gonna actually go through with it. But I know it's a good market. The whole entire Midwest is a good market, really,
Mhm.
for creating financing. So, you know,
So
I
I
might
used,
check. Oh, go ahead. Sorry.
I was just going to say, I follow a company called ICG, and what they do is they study the housing market across the country and determine which markets are the best places to buy rental properties in.
Mm-hmm.
And it was based on their advice that I started looking in Oklahoma City. And I know they had places in Louisiana and Florida that they were talking about. I can't remember what all of their top markets were. But Oklahoma City was the reason I was looking there was because of them. They study employment, industry, taxes, housing value, rentals, you know, rent amounts, and determine which ones are the most the best places around the country to invest in rental properties.
Okay. Did they tell you about the tornadoes in Oklahoma?
No, but I know about them. I've been
Okay.
caught in a hailstorm, and I grew up in the Midwest, and I know tornadoes. They're pretty used to them by now.
Okay.
But yeah, a lot of them have either a tornado shelter or a basement, especially the newer homes.
Okay.
Well, Steve, you had a question. You said have multiple exit strategies worked out before you put money in. So what are some of those exit strategies?
So we have to think through it took me several. There's a guy named Gary Johnston who does a marvelous real estate education, and he says you can come to the seminar, or you can pay for a really expensive seminar. And I've paid for some really expensive seminars, which means there are things that have gone wrong. So if look, when you get in, you gotta start to figure out how you're going to get out. Gotta make sure that if you're putting financing in, that it matches up. So I've funded some deals. So what happens if it blows up? What happens if there's a first mortgage ahead of you? If you're giving money to a flipper or a spec builder? What happens if the market pivots? What happens if the contractor gets distracted and goes and starts building another house? That happened. Bought a lot, started the house. Contractor's wife says, "I want one of those on that lot over there." So the crew moved over there. My lot sat for 6 months. Right? So that deal had interest in it, had a preferred return, and a percentage of the profits. My preferred, by the time he got back to my house and finished it, my preferred return used up all of the profit in the deal. So he wound up building me a house and didn't make any money. So that's part of it. We are in a just astonishingly just we can't seem to do anything wrong in real estate right now. But we did have a time when the banks stopped lending and prices dropped, and that's how a bunch of people got rich. I know a guy that bought 100 second mortgages in Southern California and turned them all into rentals. was just incredible. You know, I'm not that smart, right? So I put money in a deal, and I want to make sure that there's some sort of penalty if you don't perform, right? Some more points, some more fees. But at some point in a project, you're in this, like, if they don't move forward, it's done. You buy an out of town rental, and what if the property manager oversold you on the tenants? What if he what if they put a tenant in and they destroy the property? I've had that. I had a woman living in a house where the the upstairs toilet was leaking through the kitchen floor, and they continued to live there and cook in that kitchen, and just it was awful. It was awful, you know. So when we do stuff, particularly out of town, I love that Google Maps, you can drive around the neighborhood, right? You know, you can go around the corner. What I was doing in the beginning is I'd park in front of the house and I just do a 360 and say, oh, it's all okay. Well, you move down the block a little bit and boarded up house, vacant lot, right? And you go, okay, mine is the last house standing. Maybe I need to lower my price a little bit, right? Where else have I? So I've had partners not put the capital into the project, that they've taken it home, right? So, you know, so you got to think about who controls funds. Mostly making sure that if things stop, am I going to be okay? We put $200,000 into a spec build in Beverly Hills. The address is, write this down, 1200 Linda Flora in Los Angeles. Linda and Flora, Flora. We put $200,000, part of $1.5 million that was raised as the equity partners to build this house. And I had to sue to take control. I had to lend more money in so that to buy him out of his default on his first mortgage. He had a construction loan at 11% interest that had an interest carry of $35,000 a month. I couldn't cover that. There's no way that I could have covered that. So here I was sitting in second position with a group of passive investors that were like, we don't know what to do. And I'm like, I know what to do. I used to be a bill collector, right? So I lent him $100,000 on top of the $200,000 that was in default, so that I could bring his note current. And then I defaulted him on my third mortgage, my $100,000. I lent him $100,000 due in 30 days. He couldn't do it, so I was able to file for default ahead of the first mortgage, who he owed $3.5 million to. Why were the $3.5 million people not worried? Has anybody looked up 1200 Linda Flora yet? Okay, how much did that house sell for?
7.1 million.
Uh-huh.
Yeah.
Uh-huh.
Wow.
The bank didn't care. Just adding $35,000 a month to what that property was, they would have run that thing out to $6.5 million before they kicked him out.
Beautiful property.
It is incredible. The man knows how to build a house. He can't be trusted. Right?
Wow.
He's that guy you come away with going, what a great guy. Where's my wallet and my watch? Right? You know. And the syndicator that put that group together is the same way. They charged him 20% to raise that money. They made $300,000 to have a Saturday webinar, a Saturday meeting where they pitched us this thing, and I bet, but the project was right, but he didn't know how to run the books. He didn't know how to run the numbers. He wound up with a 6-month delay too. He had a problem with a city inspector like LaDacia did. Except his city inspector red tagged the elevator that he built in the middle of the building. He had to put in another elevator. He had to put like in another elevator. He had to do something like the weight wasn't enough or something. But that was really hairy, right? That was really hairy. So you don't want to be behind something that you can't handle. You don't want to be, when I bought that shopping center went 80% economically vacant, right? So like you said, the mall went empty, right? So how am I going to get out? What do I have to do if I have to take it back? Can I rent it? Can I live in it? Would I want to rent it? Would I want to, if I flew out there, could I make it better? No. If I show up on any job site, the only thing that happens is money starts to get spent. And I am useless on, in construction. But can I structure a loan if there's a problem? Yeah, I can do that. Right. So if I'm buying a rental, how am I going to get my rents collected? What are the eviction laws? The eviction laws are really weird right now. There's a squatter living in the in-law unit behind my son's house right now. Right? Police can't get him out. Property manager can't get him out. He's living in LA rent-free and has been for months. Can't do a thing about it. Right? So, how do we prepare for that?
Okay.
So I'm going to tell you to try to buy where you know. For me, it's not where I know, it's who I know. So I want to do deals with people where I can do 1, then 2, then 5, then 10, right? That I've got people that I can trust that way. I've got a guy he lives in Denver, and he trades real estate in primarily Oregon. And I've bought 60 notes from him. He's a machine. Sells properties at the right price. He brings in the right people. But every time one of those notes go bad, he replaces it with another note, even though he doesn't have to. He can leave me with the delinquency, but he buys them back and he says, well, okay, we'll swap that one out and give you another. He has hundreds of people paying him $199 a month. He sells vacant lots, rural, places you can park a fifth wheel, a motorhome kind of thing. He sells those for like $10,000 on terms. So it's almost all counterparty risk. Like, are you dealing with the right folks? We talked about this Joaquin project for a little bit, and if I'm perfectly content to put money there and say I'm going to see it in 2 years, as long as I know what are the things that are supposed to happen. Are we moving down the line like we're supposed to? And what am I going to do if it doesn't? Well, I'll have a half-finished project that I can sell. I have, what happens if we have another hurricane? Well, sometime in the next 2 years, we're probably going to have another hurricane in Pensacola, right? So, so we put in, what are the things we do first? The first thing is we get the ground prepared for that. Then we get the sewage. If we run the utilities in, we've just improved the value of the property. I bought that lot at a tax deed for, I think I'm all in for $63,000. And that property is worth at least 100 right now, because I know the lot a couple over went for 150. Right? So I know for sure that I should be able, no, not for sure. I'm pretty confident that I can sell that lot today for $100,000 once it has plans put on it. Right? Right? So what am I gonna do if my partner decides that they don't want to play anymore, right? Or again, like I said, the contractor that went off to build another house. That man had been building houses in Gulf Breeze, Florida for 25 years. He just took his eye off the ball, and it cost him. I was okay, right? So nothing finishes on time, and nothing I've ever done has ever finished under budget. Right? It doesn't. You know, I bought that shopping center. I hit the home run, right? I was 50 years old. I had sold this business for millions of dollars, and I was going to go play golf. This property was supposed to pay me $15,000 a month in free cash flow. I had to feed that property $100,000 a year to keep it. Right? I could, right? I could. I was lucky that I could. Right? So I don't like 25% down anymore. I like 40% down. Right? Because I'm 65, I am not going back to rebuild this again. This is my last shot, right? So if you're starting out and you've got your first $25,000, it's really hard if you lose that. So find something that's, back to my slide that said, I should be focused on things that are boring. And I just can't seem to figure that out. So I'm counting on LaDacia smiling, because I'm counting on LaDacia to be really boring.
Right.
Right? 60,000 equals $900 in rent. 60,000 equals $900 in rent. Do it again and again and again and again. Buy me out. Buy me out. Buy me out. Turn it over. Buy me out. Turn it over. Right?
12 to 16 units isn't boring.
Well, for you, it's not, because you're going to get to build them and look at them and own them forever. And I just want, my half of the rent, right? Or more specifically, I want my kids to have my half of the rent after I'm gone, right? I mean, that's what Joaquin is for me, is a generational thing. I mean, that's a 30-year hold, right?
Yep.
Yeah. That's the basis for what we do with other things. I've got that house in Santa Rosa, up in Rohnert Park, that's got, it's 50% loan to value. I'm not going to monkey with that. I've got a free and clear in Pensacola that I should be using as collateral for construction loans. But we haven't found one exciting enough, and we may use it for part of Joaquin. Yeah. So I'm not good at playing the leveraging my down payments, my equity money. I turn down money partners, but Joaquin may be the project that gets us to take some partners in, or the one that sets us up for here's our proof of concept for doing others.
Right.
LaDacia and I are still working on trying to get a pro forma that makes sense for doing mobile homes. I found $30,000 mobile homes to ship to Alexandria, and you take a $30,000 mobile home and turn it into a $600 a month rental. That seems like it's like that should be just done, right? Easy peasy. Give me 20. But we got stuff like, there's a lead line coming in. There's a lead water line that has to be replaced. Oh, there's storm damage that needs to be cleared. Oh, we got to get permitting. Oh, we have this. Oh, we have that. Oh, there's like 19 different bureaucrats that I have to go make friends with. You know, the city attorney didn't call me back. I have to call her, I guess.
Yes, you did say that.
Yeah. And so I'll making my note now for tomorrow. Yeah, but yeah, I said I'm doing too many things in too many places, so you know that I drop balls all the time. You know, I drop balls all the time. This guy with his $500 payment that I'm like, give him another month. His life isn't going to be any better in February than it is right now. You know, it's just not. You know, and but again, he's paid me $13,000 against a $25,000 mortgage. And you know, do I want to be at this stage the guy that says you got to go? You know, no. I mean, I'd like to rewrite that note down to something that he can manage. You know, so. But, anyway, and that's the value of the creative finance thing. It, you know, as Kenny was talking about, is I can make note terms whatever I want to make them. You know, and I don't have to make a 17% IRR on every deal. Yeah, I mean, that house is probably worth, that little house that was such a mess when he got it. I know there's a new roof on it. I know there's been some work done. It's probably worth 50 and he only owes 13. So, you know, it's okay. You know, it's okay. You know, I can wait. You know, so anyway, what else we have? I'm past my hour mark. So, all right. So let's wrap up. I want to thank you all for being here. We try to do this every month. I'll put this up on YouTube under my name, Steve Hodgden, tomorrow. My phone number was in the slides. Happy to take calls, happy to talk about, you know, obviously I'll talk about this stuff all day and all night. And so I wish you all health and great success. And we'll see you next month. All right.
Thank you.
Okay.
Good
All
night.
right. All right. Thanks, everybody. Good to see you, Kenny.
Good night.
All right.
Thank you.
All right. Thank you. You're welcome.
Thank you.
All right. Bye.
Bye.